Welcome back, everybody, and thank you for coming back. We're turning our attention now in this next session to something called What the Cool Kids Are Doing in Estate Planning. The genesis for this particular presentation came from the fact that back in the before times, when we used to work in something called an office, we would meet up with our colleagues over the water cooler in the break room and talk about what was going on during our day. And we were just openly chatting amongst each other, and droplets were flying back and forth between us. We had no idea of the risks that we were undertaking at the time, did we? But then back in those charming, naive days, it gave us a good opportunity to be able to talk about what was on our desks and what we were doing. And hey, I'm a member of this listserv and somebody's talking about doing this particular strategy. Or, oh, I just went to a conference and I heard about this idea. Or a client has approached me and has said that some other advisor has recommended a particular tactic. What do you think about it? In some respects, we've lost the opportunity to be able to get in touch regularly enough with our colleagues to make sure that we know what is it that everybody out there is doing. Are we the only ones that are doing some of the things that are there? Or what are some of the planning strategies that make especially good sense in this environment right now, and the things that I need to be talking with clients about right now? So that's where we came up with the What the Cool Kids Are Doing in Estate Planning. And for the balance of this morning session, I'm hopeful that we can cram it with a bunch of practical tips that you'll at least hear a couple of items that you might be able to take back to your clients. Practical tip number one: if you are a male in your mid-50s doing a Google image search for cute kids to put on your PowerPoint presentation, the FBI will be all over you like you would not believe. So just be careful as you're doing your image searches and you'll be fine. The agenda that we have built up for what we're doing here in this presentation is talking a little bit about refreshing ourselves on the current climate. We dealt with a good amount of that in the federal tax update session when we were looking at inflation adjustments and exclusions and all of that, but we should also talk about what the climate looks like legislatively, at least. Then we'll talk about the strategies with leveraged wealth transfers that continue to make sense. In fact, two in particular that can make especially good sense in what remains of a low interest rate environment. We should then talk a little bit about the application of that $10,000 cap on the deduction for state and local taxes that we've had since 2018. Yes, we've had it since 2018, and yes, it's supposed to go away at the end of 2025, but sometimes things have a nasty way of sticking around for a while, and people are still kind of thinking about what are some ways that we can either multiply the number of caps or at least be able to minimize the type of property that might be subject to that potential cap, so we'll talk about that. Then we'll talk about the use of the so-called ING trust, the Incomplete Gift Non-Grantor Trust, and how it can be a very useful device for avoiding state income tax in a number of situations, particularly after having been given a blessing by the United States Supreme Court. As promised, we'll talk a little bit more about the Secure Act, and in particular, we'll talk about using charitable trusts as your beneficiaries in your IRAs and in your defined contribution and defined benefit plans, or for the defined contribution plans anyway, to really be able to mimic the stretch out that we were able to get before the restrictions came in under the Secure Act. Next, we'll talk about the so-called 99-year GRAT, or the ultra long-term GRAT, where we are making a bet about the future of the 75-20 rates and seeing if we can leverage a little bit of something out of that. As promised, we will talk then also about spousal lifetime access trusts, about how those continue to make sense. I mean, they were originally created in an environment where we thought the exclusion amount was going to be dropping down, but it turns out that even in an environment where we don't think that the exclusion is going to go anywhere anytime soon, in the right situation, a slat can still make an awful lot of sense. And to the extent that we have some time left over, we'll talk a little bit about some other ideas for making sure that we can maximize the step up in basis at every turn. As Megan Trainor taught us several summers ago, it's all about that basis, and we want to make sure that we're fully leveraging the step up as much as possible. But let's get started with a reminder about planning in the current climate. We've already talked about income tax rates, and we've talked about the annual exclusion changes and increasing interest rates, and about how we have a higher exclusion amount that's going to come into play starting in next year. But one thing that we did not talk about in the opening session are what could happen legislatively in the short term. You'll recall that every spring, the presidential administration unleashes its budget proposal for the year. It's officially called the Fiscal Year Revenue Proposals, but informally in the Hill, it's known as the Green Book. It is the document that sets forth a legislative agenda and says, and here are the different ways in which I think we can pay for things. For the most part, a number of the provisions inside of the Green Book and the revenue proposals that it comes for are things that we've seen for a number of years and don't surprise anybody. But let's take a look at some of them. The Green Book would say, well, we could pay for an awful lot of our social program agenda if we could go, not back to, but increase the tax rate that applies to C corporations from a flat 21% to instead having two brackets of 21% and 28%. Sure enough, we see about increasing the marginal tax rates up to 39.6%, eliminating preferential rates on long-term capital gains and dividends if you're already making more than $1 million, that sort of thing. But there's three in particular here that I want to focus on. The first of these now appearing in red. The proposal would be that not just death being an income tax realization event, but so too would a gift. So if I made a gift of Blackacre to a child, I would now have to recognize any built-in gain on that. The child would no longer take a carryover basis. The child would get a fair market value basis, but that's because I'm the one who's going to be paying the tax just to make the gift. Alternatively, or actually not alternatively, but in addition to that, the Green Book says that we should make death a realization event, very similar to what happens under Canadian law, where there is no estate tax, but instead there's a deemed disposition of all of your capital assets at death so that we collect all of the tax on the built-in gains that accrue at that point, and then we give the beneficiaries that freshly stepped up basis going forward. Now, interestingly, while the Green Book calls for making death a realization event for income tax purposes, it does not suggest doing anything as far as the estate tax is concerned. In other words, we would continue to have an estate tax, and we know that that's the case because the Green Book talks about using the capital gains tax that you'd be paying at death as an administration expense on the estate tax return. That strikes some people as being particularly draconian to say, well, part of the reason why you say we have an estate tax is because we don't tax that wealth for income tax purposes at death, or at least all of that appreciation in the value. And here we'd be hitting both right at the time of death. So yikes, that could be something. The next item, we already talked in the morning session a little bit about grantor retained annuity trusts, and we'll focus on them again here in this session. Right now, you have the ability to do what we call a zeroed out GRAT. That is where you can structure the size of the grantor's retained annuity interest to be large enough that the present value of the remainder interest that passes to the other beneficiaries effectively becomes zero, so that you're not making a taxable gift when you form the GRAT. And as long as the trust actually gets a rate of return that's in excess of the applicable rate of interest that's in effect at the time that the transfer is made, then you can really come out ahead because there can be a substantial amount left, in fact, inside of the trust on which you're paying no gift tax, and if you've survived the term of the GRAT, no estate tax either. Well, if we lost the ability to zero out a GRAT and we're told that when we design a GRAT, it would have to have a present value remainder interest worth at least 25% of the value of the assets going into the GRAT, that would make the GRAT a much less attractive vehicle. It would more or less drive a stake through the heart of GRAT planning as we know it. Almost as bad as the next item on the list that would say making a transfer to a defective grantor trust would become a taxable event. That would effectively shut down the installment sale to the defective grantor trust technique, which we'll be talking about here in a little bit. So why are we raising all of this stuff? Well, let's remember big picture about what's going on here. As we said at the beginning of our time together this morning, nobody is expecting that there will be any significant tax legislation that will pass, certainly not in calendar 2022, and very likely not in 2023, probably not even in 2024. Certainly not if there's going to be a red wave in the midterm elections such that Republicans take control of Article 1 of the Constitution, because when you have one party controlling Article 1 and the other party controlling Article 2, there's not a whole lot that's going to get done, right? Even if the Democrats can hold on to the Senate, nobody's projecting that they would have a wider margin of influence that they have now. And as it is, Democrats have been able to get very little accomplished in the time when they've had theoretical control, even if by a tie-breaking vote over the legislative branch. So no one can feel particularly compelled to say, ooh, this is coming to a theater near you. It's going to be happening right away. But still, it's important to keep these proposals in mind. Why? Because sometimes these proposals, or parts of them, have a funny way of finding themselves into bills that have nothing to do with taxation generally. I have in mind a few years ago when the basis consistency rules were enacted under Section 1014F. You'll remember that under the basis consistency rules now, the step up in basis for a particular asset is limited to, or cannot exceed, the value of that asset as it is shown on an estate tax return. Once upon a time, taxpayers used to engage in a little bit of a whipsaw in that they would take a deep discount in valuing the asset on an estate tax return. But when it came time to say, well, what was the step up in basis for that asset in the hands of the new beneficiary, they'd say, well, magically, a lot of those discounts don't really matter much anymore, and the asset is worth far more than what it was shown on the estate tax return. Congress enacts a simple rule that says whatever you show on the estate tax return, that's going to be the maximum amount that will carry over as your step up in basis. Relatively straightforward, but it was a revenue raiser. That had been in the Green Book for a number of years until suddenly Congress was wanting to pass a highway bill. They needed X dollars worth of projected revenue, so they went scouring through the Green Book looking for some proposal that would give them X dollars worth of projected revenue. And the basis consistency rule fit the bill, so yoink, that provision was taken out of the Green Book, slapped into the highway bill, and it became law. So sometimes some of these proposals have a way of backdooring their way into other legislation. So if we have at some point in 2023 or 2024 a new rule about grant remainders or a new rule about sales to defective grantor trusts, we can't just pretend to be shocked like the kid in Home Alone to find out, oh my gosh, the rules have changed, because this Green Book is giving us some early indications this could potentially happen. Which means if we're thinking about engaging in any of these strategies, we need to do so sooner rather than later. In fact, that's going to be a big recurring theme here in our time this morning. Some of the strategies, many of the strategies that we'll be talking about, work very well when interest rates are relatively low. And when we see that next month the 75-20 rate is going up by nearly 1%, interest rates are not continuing to be low. So if a client is going to pull the trigger on a particular strategy that's dependent upon or is very successful in a low interest rate environment, you got to have a conversation with a client, perhaps later this afternoon, in which you tell the client, look, now is the time to paint or get off the ladder, which was not the metaphor I learned as a child growing up, but it's the one that I can use in a broadcast that's going around the country, right? So yeah, they need to act sooner rather than later if they want to get something done. All right, so in light of this current climate that we have been talking about, what are the strategies that kind of make sense? A number of commentators are telling you this is a good time now to be harvesting the capital gains inside of your portfolio. I have a big question mark next to that because I don't quite see it myself. We don't really see any realistic chance that the capital gains preferential rate is going to disappear. That was originally proposed in last year's American Families Plan, but by the time the House Ways and Means Committee issued the Build Back Better Act, gone was that proposal about restricting the preferential rates on taxpayers who are making more than $1 million. So I'm not sure where people are getting the idea, unless you have a whole bunch of capital losses that you need to use up inside of your portfolio. I don't know why 2022 would necessarily be the year in which you need to be liquidating gains out of your portfolio. So, always stay tuned for things, but I don't think there's anything that points in that particular direction right now. The next one, while I have a question mark next to it too, I think I can kind of at least see the argument for this. The Build Back Better Act did contain a provision that said you would not be allowed to do a Roth conversion if you were making more than $400,000. So the benefit of a Roth conversion was going to be limited to moderate and low income taxpayers with their IRAs. Now, people aren't doing Roth conversions left and right. I mean, a Roth conversion, again, typically only makes sense only if you expect that at the time you are receiving distributions from your IRA, you would be taxed at a higher rate than you are now. Because to make the conversion, you're having to pay tax on amounts that you weren't paying tax on before, just so that you can have the benefit of tax-free withdrawals from the Roth when it comes time for you to reach the age of taking out your distributions. If you were in 2020, if you were in a year in which because of the economy or because of changes in the tax laws, you were going to be in a lower bracket on a one-time only basis, that could be a great time to do a Roth conversion. But that may not be happening anytime soon. And again, it was a provision that while it was in the Build Back Better Act, never ultimately became law. But it did at least advance a lot further than the idea of doing things like eliminating preferential rates on capital gains. So we couldn't be surprised if that particular limitation were to come into play again. So if I'm working with a client that's making more than $400,000, and if their financial advisor has said, maybe a Roth conversion makes sense in your case, then I might want to say, if we're going to do it, let's do it before a new rule that might come in and could change it. But one thing that certainly does make sense in the current climate, and that is go ahead and be making your leveraged wealth transfers. That is your gifts that don't utilize all or any portion of your basic exclusion amount. When you think the exclusion amount is going down, that's when you want to be using the exclusion amount if you're comfortable making a gift, remember, that's going to be in excess of what the reduced exclusion is predicted to be. But if you're not anticipating that the exclusion amount is going to go down, you don't necessarily have to be in a hurry to utilize that exclusion now, because again, it can be still there and waiting for you at death. Leveraged wealth transfers, where I can transfer just as much wealth but not have to utilize any of my exclusion, can still be and remains a very effective way to make the transfer. So if you're going to work with a client who is thinking about making a large gift, I think there's two strategies in the current climate that make especially good sense. And one of them is the good old-fashioned installment sale to the defective trust. And given that the Green Book is wanting to shut down this strategy, again, if I'm working with a client for whom I think this strategy might work, I might want to be doing so sometime this year or in early 2023 or before it looks like Congress might be in need of some revenue and is going to be looking for some easy ways to generate that revenue. To refresh your recollection about, we've been doing installment sales to defective trusts for over a generation now. It's almost estate planning 101. But to refresh our recollection about how this works and why this is so particularly advantageous right now, let's use a simple example where we need two things. We need to have the settlor, or the grantor of the trust, and we need to have that irrevocable trust. That irrevocable trust set up as a grantor trust for income tax purposes. Remember, the name Defective Grantor Trust, that's another person I want to meet in a dark alley, by the way, the marketing guru that came up with that term. The Defective Grantor Trust is one which is a grantor trust for income tax purposes. The grantor is the deemed owner of the trust assets for income tax purposes, but which is not owned by the grantor for transfer tax purposes, meaning that the assets of that trust will not be included in the grantor's gross estate at the grantor's death. If we had a mulligan in the name of this, if anything, we would call this the Effective Grantor Trust, or we would call it the Super Grantor Trust, because it gives us the best of both worlds. We get to have low income taxation because undistributed income is taxed to a human being rather than to the trust itself at the anemically thin tax brackets. And we could be shifting out not just the value of the assets, but of all subsequent growth in the value of those assets and protect it all from transfer tax at the same time. It really is the best of both worlds that way. All right, so what happens in this particular transaction is that the grantor takes some asset that we are expecting to be appreciating rapidly in value between now and the date of the grantor's death, not a transfer by gift, but instead that we are going to sell those assets to the trustee in exchange for a promissory note. Remember, we went to law school to call it a promissory note rather than an IOU. Now, this promissory note can take any number of forms. There's a whole bunch of ways to skin the cat, or for vegans that are watching, skin the tofu. To do that, in its most vanilla form, the way that the transaction typically works is that the trustee issues a note that requires the trustee to make annual payments of interest at whatever is the applicable federal rate of interest in effect at the time of the transaction. So if this were to go down now, let's be more realistic. If it was to go down next month in November, and let's say that this particular note was going to last for more than 3, but not more than 9 years. That would mean that the trustee would be paying interest at what is called the midterm rate of interest, whatever that is, in November of 2022. Well, the midterm rate in November of 2022 is 3.98%. Or for those of us who went to public school like me and were liberal arts majors, we'll just call it 4%. So it is at 4%, but it's at 4% throughout the more than 3 to up to 9 year term. It doesn't change every month as the interest rate changes. It locks in at the time of the sale. So in this example, the trustee would be paying 4% interest back to the grantor each year for the length of the note, which we'll say is 9 years. We might as well make this thing last for as long as we can if we assume interest rates are only going to go up. So 4% a year each year for 9 years. At the end of the 9th year, the balance on the note becomes immediately due and payable with one big old balloon payment that the trustee will make at that time. All right? Let's analyze this transaction from a tax perspective. Because the settlor, because the grantor is selling the asset for its fair market value, as long as the principal balance of that note is equal to the fair market value of the asset going into the trust, then this is not a gift that would utilize any portion of an annual exclusion. It would not eat up any of the basic exclusion amount. It would not generate any liability for federal gift tax, because from a gift tax lens, this would be seen as a sale for full and adequate consideration in money or money's worth. So we're not making a gift. We're not paying any gift tax on the transaction. Importantly, from an income tax perspective, this is also a tax nothing. The settlor does not recognize any gain, and the settlor is not having to include in gross income those 4% annual interest payments that are being made by the trustee. Why not? Well, the reason why not is because of Revenue Ruling 8513. It's the one revenue ruling that we all know by name. Why is that? Because every morning estate planners get up, they unroll their prayer mats, they get down on their knees, they face toward Washington, D.C., and they thank Almighty Treasury for issuing Revenue Ruling 8513. It's the revenue ruling that says that transactions between a grantor and a grantor trust are disregarded for income tax purposes. Since the grantor is already the deemed owner of the assets of the grantor trust, then when the grantor transacts with the trust, in effect, the grantor is transacting with the grantor. So when you sell an asset to your grantor trust, you are transacting with yourself. And Revenue Ruling 8513 confirms what you learned in high school health. Transacting with yourself is perfectly normal. It is perfectly healthy. It's nothing to be ashamed about. It's just we have this unwritten rule that just says, clean up after yourself and let us never speak of this again. And Revenue Ruling 8513 just says transactions between grantor and grantor trust, we don't need you disclosing that on a return. You go for it, you do you, but we don't need to see it on a return because from an income tax perspective, it's a nothing. So we have no gift, we have no income tax consequence, and now let's talk about the estate tax consequence. If the settlor dies while this note is still outstanding, there will be inclusion in the settlor's gross estate, but it will be inclusion of the promissory note, Because remember, the assets are now sitting inside of an irrevocable trust, and those assets inside of that trust are not subject to estate tax when the grantor dies. What's subject to estate tax is what the grantor still owns. That's the note. Well, now think this through. The grantor is going to hold at death a note that requires the payment of 4% interest. If interest rates increase significantly between the date of the sale and the date of the client's death, suppose, for example, interest rate, the midterm rate goes up from 4% to 6%. The grantor dies holding a note that's only paying 4% interest. What's the fair market value of that note going to be? It's not going to be the full principal amount, because a willing buyer is going to say, yeah, but I can go out and get a 6% note from some yahoo out on the street, no questions asked. This one's only going to pay 4%. I'm not going to pay you the full principal balance of that amount. I'm going to pay you something less. So what's included in the client's gross estate is not just the original principal amount of the note. In fact, it will be worth something less than that amount because interest rates have gone up. Now, theoretically, interest rates could go back down again, right? I mean, interest rates could plummet between now and the next several years. Who knows? All bets are off. If interest rates go down from 4% down to 1%, well, now all of a sudden you die holding a note that's paying you 4%. People are going to pay you a premium. They will pay you more than the principal balance to be able to get their hands on it at that point. So it's not as though this strategy is without risk at all. But back in the times when interest rates were at 1% or lower, you were feeling pretty confident that interest rates were not going to go down any further. If anything, interest rates were going to go up. And so this was a great technique, not just for freezing the value in the client's gross estate, but in fact, even reducing the amount that would be subject to estate tax at death. Well, now that interest rates have started to climb back up again, we introduce the element of risk, right? The 4% rate now could go down by the time the client dies, but I think still more likely we say interest will probably be higher over the course of the next 9 years than it is now. But even if it stays relatively steady, I'm still freezing the amount that is included in the client's estate. And if in fact interest rates are increasing, at least the property that I transferred into the trust hopefully is growing like Jiffy Pop popcorn and just really exploding in value and being really fantastic. So again, the strategy worked especially well in January of this year or in all of 2021, but I still think that there's some room for it because whatever's left inside of that trust, however much it has grown, is going to be something that's going to be there and available for the beneficiaries, who you can see, unlike their settlor, they can afford clothes. And that's because this trust worked out really well and gave them some appreciation. So it can be a pretty nice little strategy. Okay. Another strategy that I think works especially well in the current climate beyond the installment sale transaction is the charitable lead trust. Whether it takes the form, now on this slide we're going to be using as our example the charitable lead annuity trust or the CLAT, but you can get this same benefit from a charitable lead unitrust known as the CLUT. For the most part, a lot of us are very familiar with charitable remainder trusts. We work with charitable remainder trusts all the time. We know that those are a great device for securing an income tax deduction, but being able to defer the subsequent income when the trust sells an asset that has been donated to it. We can still provide for one's favorite charitable organization. There's a whole host of upsides to it. But then with the charitable remainder trust too, there's a whole lot of restrictions that come into play too. That you have to be very comfortable navigating around to make sure that you're not accidentally creating something that fails and thus doesn't get the deductions that you were hoping for. The charitable lead trust is the mirror image of it. Lead trusts don't get as much attention as remainder trusts because charitable lead trusts do not offer you an income tax advantage. What they offer you is a transfer tax advantage. But when that transfer tax advantage can present itself, oh howdy, it can be quite sweet indeed. Let's talk about the basic mechanics of how the lead trust works, and then we'll explain why it works especially well right now. In the typical lead trust, donor transfers property irrevocably to an irrevocable trust that is a separate taxable entity from the grantor. And during a term of years that is specified up front, it could be 5 years, it could be 10 years, it could be 20 years, it could be 30 years. For a term of years, The trustee, in the case of a CLAT, will pay a fixed dollar amount each year for that term of years to the charitable organization or charitable organizations of the grantor's choice. So we can say a flat dollar amount is going to the Salvation Army each year for a number of years. At the end of that term of years, whatever is left in the cookie jar that is called the trust, if anything, it will be distributed to the non-charitable beneficiaries. Typically, that is either to children or grandchildren or to a trust for the benefit of children or grandchildren. All right, that's how it works. The lead trust is a little bit more flexible than the remainder trust because when I create a charitable remainder trust, I have to design it so that the retained annuity interest or unitrust interest that the settlor will receive has to be worth at least 5%, but no more than 50% of the value of the assets going into the trust. And furthermore, as I engineer the size of the retained interest, which then affects the value of the remainder interest going to charity, I have to make sure that the present value of the charity's remainder interest has to be worth at least 10% of the value of the assets going in. And if I don't comply with all those mathematical requirements, I don't have a valid charitable remainder trust and it doesn't work. Charitable lead trust, on the other hand, I can make the charity's lead interest as big or as small as I want to. I can make the remainder interest passing to the kids to be as large or as small as I want, and there's the benefit. I can make it as small as I want. I can zero it out. I can zero out the remainder in a charitable lead trust so that I am not making a taxable gift at all. From an income tax perspective, I am not getting an income tax deduction when I donate the property into the trust. It's the trust that is getting an income tax deduction when it makes the annual payments to the Salvation Army. So you're not doing this strategy when you yourself are looking for the income tax deduction. What you're looking for is the estate tax savings because you are making a gift of the present value of the remainder interest, but you can zero that out so that you are not making a taxable gift at all. Importantly, though, because there's no arrow on this diagram that is coming back toward the settlor, there is no retained interest. There is no inclusion of the value of these trust assets in the donor's gross estate, no matter how large the value of those assets will be at the time of the donor's death. So the charitable lead trust, again, makes especially good sense when you have a donor who doesn't really need any retained cash flow from the asset. They don't really need or can do without the income tax deduction that would be associated with a remainder trust. They're fine with the charity receiving a present interest in the trust assets as opposed to a future interest. And if you have a client who can tolerate a little bit of complexity in the design of the trust, you can really milk this thing for some serious benefit. You can do something called a step clat, where the size of the amount of the charity's annuity changes from year to year. It either increases by a set amount, stepping upward, or decreases by a set amount, steps downward. You can do that with the lead trust. You can do something called the shark fin clat. We don't get out much, do we? Under the shark fin clat, the amount that you pay to the charity during the lead interest is very, very small for almost all of the years. But then in the last year, just before the trust dissolves, you make one large payment to the charity. And then the lead interest is over. So that if you were plotting it on a graph, it looks like a shark fin sticking out of the water. You can do that and make it work if you want to that way. So depending upon the assets that you're looking to transfer in and when you might be looking at doing a sale of those assets, and again, how you want the comparative size and the nature of the lead interest and the remainder interest to work, the world is your oyster. You've got an almost infinite number of planning options that you can do with it that way. All right, so why are we harping on lead trusts here and saying that they make especially good sense right now? Well, let's take a simple example here. I think sometimes when you see the numbers in front of you, it starts to make sense about why this particular strategy might work. Now, because I work at Georgia State University, a public school, my school will not spring for the money for me to be able to buy the software that most of you have instant access to, whether it's Number Cruncher or any of the other alternative programs where you can just say, if I put in this amount and I want to zero out the size of the remainder, what's the size of the annuity that I have to give? And before you're even done inputting the values, it's already told you, here it is, this is what you want to do. Instead, I have to use Google, and I have to be looking around for free calculators online. And I found this one from Louisiana Public Broadcasting. That's the day when I learned Louisiana had public broadcasting. Good for them. Well, LPB has this gift calculator that I could use for a lead trust. So what I said is, all right, let me hypothetically take my entire salary from Georgia State University and then add 3 zeros to it, and throw that amount, in this case $10 million, into a charitable lead trust that, as you see, has a 20-year term. Now, because I am creating the trust this month in October of 2022, in order to compute the present value of the remainder interest that would go to my non-charitable beneficiary 20 years from now, I have to use, because it's a charitable trust, Section 7520 says that I can use either this month's 7520 rate, which is 4%, or I can use the 7520 rate from either of the prior 2 months, the August rate, which was 3.8%, or the September rate, which was 3.6%. This strategy works best with the lowest rate. So I'm using the rate from September of this year of 3.6%. Now, according to the calculator there, in order for me to get a value of 0 for the value of the remainder interest, which you see all the way down there on the lower right-hand corner of the screen, I have to pay to the charity an annuity interest equal to 7.1% of the amount going in. So see, it doesn't really matter. The numbers don't change here whether I put in $10 million, $100 million, or $2 million. The base number doesn't matter. It's the percentage of the annuity interest that matters. If I pay a 7.1% interest annuity to the charity each year for 20 years, then I have zeroed out the value of the remainder. And in case that's not entirely intuitive, let's walk through as to why that's the case. Section 7520 is forcing me to assume that throughout the 20-year existence of this lead trust, these assets are going to be growing at a rate of 3.6% a year. That's it. Even though it is very likely that the assets are going to be growing over a 20-year term, the rate of return is going to be more than 3.6%. I mean, heck, if the trustee of this trust can't generate more than 3.6% average rate of return over 20 years, that trustee has another title called defendant. Right? Because they're not managing the property very well in that situation. But nonetheless, 7520 forces me to assume that this trust is only growing at 3.6% every year for 20 years. And it's also making me assume that the trust is receiving $710,000 or 7.1% out of the trust every year. So under 7520's own mandatory assumptions, every year, I'm completely exhausting all of the growth and I'm dipping into the principal to be able to satisfy the 7.1% that is supposed to be paid to the charity. So after 20 years of doing this exercise, there's going to be nothing left in the cookie jar, not even any crumbs. And even I, the liberal arts major who goes to public school, I know that the present value of 0 is 0. If there's nothing that's left in there, I've completely zeroed out the trust. But now here's the thing. You and I know that the trustee is going to do better than 3.6%. As long as that trust can get an average rate of return over the 20-year lead trust term of better than 3.6%, by definition, there will be cookies left inside of the cookie jar. And whatever goes to the remainder beneficiaries is going to be completely free of gift tax, completely free of estate tax, and they're going to receive it free of income tax. It's a pretty sweet little world, right? In fact, get this as a mind bender, if the trustee can generate an average rate of return of 7.1%, the amount that we're paying to the charity, then we know that there will be $10 million left inside of that trust. The original corpus amount will still be sitting there untouched. And if we can get 8%, if we can get 9%, if we can get a 10% rate of return, dare to dream, there's going to be more than $10 million sitting inside of that trust, and all of it is passed completely free of any kind of tax. Now, when the 75/20 rate was at 0.4%, as you can imagine, the percentage annuity that I had to pay to the charity was ridiculously small. We're talking in the 2 to 3% range. As the 75/20 rate has been going up, so too is the annuity that I'm having to pay to the charity in order to maintain a zero gift of the value of the remainder interest. As the 75/20 rate goes up, the size of the annuity I have to pay to the charity increases, which means then there's less left in the cookie jar for the remainder beneficiaries, the greater the strain that I'm putting on the trustee to generate a rate of return that makes the transaction profitable. So for the client that's considering the charitable remainder trust, just like the installment sale, the quicker they act, the better. Now, if I do a charitable lead trust next month in November, when the 75/20 rate is 4.8%, remember, I can still use the September rate of 3.6% because I can use the November, the October, or the September rate. But when we hit December of this year, we're going to be stuck at whatever is the December rate, which might be 4.8% or more, or the November or the October rate. 4% is going to be as good as we can do. So if I have a client for whom I think a lead trust might make sense, I want them to do it before the end of November, not before the end of this year, but before the end of November, so as to maximize the benefit from this particular strategy. All right. If you have a client then who's going to be making a big gift, whether it is via the installment sale transaction or the charitable lead trust, or if they're just going to make a big old honking gift of a whole lot of wealth to a beneficiary and use up some exclusion, there's a few issues that I think that you need to be at least thinking through. For one, do I want to have language in the gifting document that explains what happens in the event the recipient decides to disclaim the gift? Remember that under the federal tax laws, Section 2518 says that a qualified disclaimer only happens if we get an irrevocable refusal in writing that is received no more than 9 months after the property has been delivered. And even then, if the donee has accepted the benefit of the gift before disclaiming it, it becomes too late. So usually a gift that's made in trust, that's much easier to disclaim because a trustee can more easily squirrel away a gifted amount into a separate segregated account that they don't touch and therefore haven't accepted the benefit of that gift. It's a much harder proposition with respect to an outright gift to an individual who is told, here's some money, but don't use it. The temptation is often a little bit too great. If we get a qualified disclaimer, though, then we pretend as though the gift had never been made, and if we have language in our instrument that says, in the event of a disclaimer, the property reverts, we basically serve to give ourselves a layer of protection in the event the value of the gifted property declines. I mean, if I make a gift of Blackacre now and it's worth $5 million, but then precipitously real estate values plummet and it's now only worth $3 million, I might regret that I made that gift. If I have disclaimer language in there, though, that makes sure that that gift comes back to me, and if I have a cooperative trustee who realizes maybe it's not so good that we're holding on to Blackacre right now, it can be a nice way to undo the transaction if it comes to that. Something else that you'll want to consider in any large gift that you make is making sure that you have some mechanism by which we have someone on the sidelines who can give the grantor a general power of appointment over the trust property. And this is where the role of that wonderful unicorn that is the trust protector comes into play. Already, we are relatively comfortable as a profession with the concept of a trust protector. This is somebody who is not the day-to-day trustee. This is somebody who's just sort of sitting on the sidelines, who holds this rather magic wand to, at some point in that trust protector's discretion, step in and be able to say, I'm going to amend the trust as follows, or I'm going to change the trustee to this new trustee, or I'm going to change the applicable governing law of this trust instrument from being an in-state trust to being a Delaware trust, for example, or a Nevada trust, or a Tennessee trust. Or importantly, I'm going to have this wand by which I can give the grantor a general power of appointment. Now, what do we have in mind here? What's going on? Well, remember, if I make a large gift into an irrevocable trust, that's wonderful from a transfer tax perspective because I'm not going to pay any estate tax on the value of that asset. And if that asset can grow and grow and grow in value, we're not going to pay any estate tax on any of that growth either. That's a great thing for the clients who face estate tax liability. What's happened over the course of the last several years, though, is that people who started off being rich have, because of increases to the basic exclusion amount, become statutorily poor. So where a client who, say, a decade ago had $5 million worth of wealth and they put that $5 million wealth into a trust, they needed the estate tax savings at that point. But now, nobody who has a mere $5 million needs to be transferring assets into an irrevocable trust just to be able to save on estate taxes. And in fact, from a tax perspective, it's a bit of a bummer because the assets inside of an irrevocable trust do not get a step up in basis for income tax purposes. So in fact, what started off as being a very tax smart transaction, hey, take this asset, pull it out of your estate so that you save on estate tax, you're not going to get the step up in basis, but a 40% estate tax is more important than a 23.8% income tax on a gain, especially when that 40% estate tax is going to be paid 9 months after death, but the 23.8% tax isn't going to be paid until much later when the asset is subsequently sold. Do it, do it, do it. It was smart at the time. But now, from a modern lens, you'd look at it and say, that's not a very smart transaction because we're already not going to be paying estate tax on that $5 million. You've got a $12 million exclusion to be able to cover everything. And importantly, we've lost the opportunity to get a step up in basis in that situation. Think about it, folks. Why do people cry at funerals? They cry because of the lost opportunity to fully leverage the step up in basis. Right? I mean, sure, we use little euphemisms like, oh, he was called home early. He's gone too soon. That's code for, darn it, we didn't get the opportunity to fully leverage that step up in basis. But instead, you go to the funeral of a decedent who did fully leverage the step up in basis, and they call it a celebration of life. Right? It's all happiness and giddiness, and they talk about the legacy that the decedent left behind. Well, that's code for cha-ching, baby. We got a full step up in basis. When you go to the party after this, there's going to be shrimp there. Right? It's not going to be BYO. The champagne will be flowing because we were able to fully leverage that step up in basis and it worked out well. Well, if you had a do-over, those assets wouldn't be sitting inside the trust. But it's an irrevocable trust, and it might be difficult to get a non-judicial agreement or even talking them into decanting might be difficult. But you know what could happen? Our old trust protector could come swooping in here, right? And when the client's breathing is labored, or if I can use the medical terminology with y'all for a second, if the client is circling the drain and we know that death is imminent, maybe what we do is we have the trust protector come in with their magic wand, don't do anything to save their life, they have a DNR. Instead, you wave the wand to give that dying client a general power of appointment over the trust property. Because you and I know, under Section 2041 of the Code, any property over which you hold a general power of appointment at your death is subject to estate tax. And at first you might be saying, Sam, are we talking about causing gross estate inclusion of assets in an irrevocable trust? For people who don't face estate tax liability, that's exactly what we're talking about. The reason why we're talking about that is because under Section 1014B9 of the Code, it's easy to remember, it's B9, it's not malignant, it's B9. Under 1014B9 of the Code, you get a step up in basis for any assets that are included in your gross estate for estate tax purposes, even if you don't pay any estate tax at all. So by giving the grantor a general power of appointment over the trust property, we cause gross estate inclusion, which in turn causes the assets inside of that trust to get a step up in basis when the grantor dies, and then the funeral is a celebration of life. So look, if trust protectors really have all these powers that statutes say that they have, giving them this power, the power to give the settlor that general power of appointment so that we preserve the ability to get a step up in basis, if we later decide that that matters more, that's great. That can work out especially well in the right situations. Okay, final issue that I think that you need to consider, if you're ever going to have a client make a large gift, make sure that they are giving value and not giving property. In other words, don't ever let a client give 2,000 shares of closely held stock. Don't ever let a client give Blackacre or a piece of artwork or a fractional interest in some asset or anything else that requires an appraisal to go along with it. Because if you give the asset, even if you have an appraisal that tells you, oh, it's below the gift tax exclusion amount, so you're good to go, if the IRS successfully challenges the appraisal as having been too aggressive in the size and amount of the discounts that it took, well, now all of a sudden you could be making a taxable gift, and you might face gift tax liability for something that was designed to have not been a taxable gift at the front end. Instead, what you do is you say, if, for example, you have $2 million of exclusion left, you say, I give $2 million worth of closely held stock. I give $2 million worth of Blackacre. I give $2 million worth of this artwork or this other difficult to value asset. Then I go get my appraisal and I have the appraisal tell me what does $2 million worth of that look like, and that's the amount that I'm going to transfer. And then if the IRS challenges the appraisal as having been too aggressive, your position is, well, what I gave was $2 million worth. If you're telling me, IRS, that $2 million worth of the asset is in fact worth less than what I ultimately transferred because the appraisal was too aggressive, well, thank you for pointing that out. We'll make that change. We'll undo that portion of the document. You're not going to collect any gift tax, of course, because what I was giving was still within my exclusion amount. But I really appreciate you bringing that to my attention. Geez, you people really put the service in Internal Revenue Service. Good on you. Well, the service hates these so-called formula clauses. They think that they are abusive of public policy. They think that they allow a taxpayer to be able to manipulate and have an easy defense. The IRS reasons every time we challenge valuation, the taxpayer is going to say, well, that just adjusts the amount of the gift that I made. I still don't pay gift tax. We will never collect gift tax if we police these appraisals. And if we're never going to collect tax, then we don't really have an incentive for us to be challenging these appraisals. You're opening up the floodgates for taxpayers to do with what they want. Now, back in the 1960s, the IRS convinced the Fourth Circuit Court of Appeals that, in fact, these kinds of formula clauses are abusive of public policy and should not be enforceable. But a little over 10 years ago now, the tax court decided a case called Wandry versus Commissioner, in which you'd had some people who'd given an interest in a limited partnership, but they only gave $2 million worth of limited partner interest as finally determined for estate tax purposes. And when the IRS challenged the appraisal, the taxpayer said, well, thank you. Now that we have finally determined the value for estate tax purposes, we're still only giving $2 million worth, and so we don't owe any tax. The IRS said that's abusive of public policy, citing the Fourth Circuit case, Proctor. And the tax court said, you know what? We think a formula clause like this is perfectly fine. And the fact that the IRS isn't going to collect any additional revenue, who cares? They still have the job to police it, even if they're not going to collect any revenue. The service couldn't believe that it had lost in the Wandry case. It appealed the case to the 10th Circuit. That was based in Denver. At the time, Colorado had just legalized marijuana. So the IRS was like, uh-oh, our oral argument has been scheduled for 4:20 in the afternoon. That doesn't bode well. So we'd be accused of harshing their mellow if we tried to say that this ought not be enforceable. So the IRS dropped its appeal, but it issued a non-acquiescence, saying, we don't like the result in this case, so beware. Which, of course, anytime they issue a non-acquiescence, that means you should be doing this because they really don't like it. And everybody's been doing it, and it's been fine. So never give property, give value. And have a formula clause that adjusts the value in the event that the amount of the valuation or the appraisal gets it wrong, and you'll be protected. Just remember, if you do it, you got to do it right. Don't be like the taxpayers in the recent tax court case from a couple of years ago, Nelson versus Commissioner. The Nelson case involved a married couple who were doing an installment sale to a defective trust. So they set up a brand new trust, and at the end of 2008, they made a gift. And this is the language that they used in their gifting document. They said, I hereby give a limited partner interest having a fair market value of $2,096,000 as of December 31, 2008, as determined by a qualified appraisal within 90 days of this assignment. So you can tell what's going on here. If you remember back in 2008, the basic exclusion amount was $2 million per person. This trust had 8 beneficiaries that had crummy powers. The annual exclusion amount that year was $12,000. So 12 times 8 beneficiaries, that's another $96,000. They made the largest gift that they could make without having to pay any gift tax to the trust, because each of them made a gift of this size on that day. So it's clear what their intent is. They're burning through whatever they have by way of exclusion and making the largest possible gift into the trust. And then 2 days later, they then sell a limited partner interest having a value of $20 million as of January 2nd, 2009, as determined by a qualified appraisal within 180 days of the assignment. Now, I'm sure it's just a coincidence that the sale takes place in a completely different calendar year than does the gift transfer that they had made. But the transactions are only separated by 2 calendar days, right? December 31 and January 2nd. And the intervening day is a federal holiday. So the Nelsons go out and they get their appraisal. They only get one appraisal, but they should only get one appraisal. These transactions are 2 days apart. The intervening day is a holiday. The value of this entity is not changing significantly during this time. One appraisal is fine. Based on the appraisal, they then compute that a limited partner interest worth $2 million is X percent, and a limited partner interest worth $20 million is Y percent. And so they reflect those transfers, they file their gift tax returns. IRS swoops in and says, well, we think that the appraisals were aggressive in their discounts, and so in fact, X percent is worth more than $2 million, Y percent is worth more than $20 million. You owe gift tax plus interest and penalties for both of those years. The Nelsons go running to tax court saying, what about Wandry? We gave value here. We're not giving a percentage interest, we are giving value. But the tax court says, look again at your language there, kids. You are saying that you are giving whatever interest the appraisal says is worth $2 million, and you are selling whatever the appraisal says is $20 million worth. In other words, you don't have an adjustment provision in any of this language. Anything that says, if in fact what I give is worth more than $2,096,000, adjust the amount of the gift. Or if what I am selling is worth more than $20 million, adjust the amount that I am selling so that it gets down to a value of $20 million. All your language does is refer to the appraisal, but whatever the appraisal says is what you are stuck with. You don't have anything that makes an adjustment. If the Nelsons had a mulligan here, what would they have done? They would have structured this to say, for example, I give the lesser of $2 million as determined by this appraisal, or my remaining basic exclusion amount. Again, whichever's less. That way, if the appraisal ends up resulting in a gift that is more than the basic exclusion amount, you have an adjustment that kicks in and lowers the amount of the gift down to the basic exclusion amount. The language that was used in Wandry said that I'm going to give $2 million as finally determined for estate tax purposes, and the Wandry court said that had the effect of doing the same thing. Some commentators have raised what I think is a legitimate point about that, saying, well, unless the IRS challenges it, we don't know what the as finally determined for estate tax purposes value of an asset is. And so this formula doesn't really exist until there's a contest and a resolution of that dispute. So how does that really work? That's why I think the lesser of language is a little bit cleaner that way, in making it clear that in no event are you giving rise to anything that could be treated as a taxable gift. So formula clauses work. Formula clauses are great. Just make sure you're using a formula clause and not just a reference to an outside source. Next up on our agenda, we are talking about planning for the $10,000 cap on the deduction for state and local taxes. Now, As I talk about this $10,000 cap at various seminars around the country, I find that people are either very interested in this topic or they're very uninterested, because as it turns out, the impact of state and local taxes really kind of matters from one jurisdiction to the next. Here, you can see it for yourself. Our friends at the Tax Foundation, every year they prepare this chart that they call their Business Tax Climate Index. And I know it's called a Business Tax Climate Index, which suggests that it's not really revealing of much by way of individual tax. But in fact, when you look at the methodology that they use for this particular chart, this chart takes into account all taxes that are imposed by state governments. They look at individual and corporate income taxes. They look at sales taxes. They look at use taxes. They look at real property taxes. They look at ad valorem taxes. They look at sin taxes. They look at everything all together and then prepare this map where you're probably not going to be able to see all of the numbers here, even if you were to stand very close to your screen and get in the way of other people who are trying to look at it too. But if you can generally make the distinction between the colors, the blue states are the low state tax states. That is, they are in the top 10 of being low state tax jurisdictions. The dark gray colored states are in the bottom 10. In other words, those are the 10 highest state tax states in terms of the overall state tax burden. Everybody else in gray is somewhere from 11 to 40 in that list. Well, let's look at some of these states. Coming in at number 1 on this chart, the lowest state tax state is Wyoming, which when you think about it makes sense, because there's what, 30 people that live in the state? 7 of them are named Cheney, so they're not going to impose any taxes anytime soon. Hell, they probably don't even have a state legislature, or if they do, it probably just rotates among the same group of people every few years. So, okay, they're number 1, but that's not a surprise. Coming in at number 2, our friends in South Dakota. South Dakota has been very strategic. A generation ago, they realized about the only thing we got going for us is a hill with 4 heads on it. So if we really want to attract investment capital, we need to do some serious things. So among the things they did, they abolished the rule against perpetuities so that you could create trusts that last forever. We thought they abolished the rule against perpetuities because nobody could pass the bar exam in that state. But it turned out, no, they were doing it on purpose to attract investment capital, and it worked. Hand in hand with that, they had to reduce tax rates, because if they were going to tax the bejubers out of that income, nobody was going to park their assets there. So they effectively get rid of taxes on trust investment income, along with being able to set up a trust that's going to last longer than will the United States of America. It becomes a pretty appealing jurisdiction, so it finishes at number 2. Nevada, of course, watches all this go down, and Nevada says, look, no other state is going to out-prostitute us when it comes to attracting investment capital. Nevada says we invented that concept in this state, so they quickly got rid of the rule against perpetuities. They quickly get rid of a lot of their taxes. Interestingly, though, Nevada is only number 7 on this list. They don't even crack the top 5 anymore. I suspect that's because Las Vegas imposes a tax on penicillin. I'll let you think about that one for a second. Coming in at number 3 on the chart, if you can see, is Alaska. And frankly, that's the one that's really alarming to me, because when I was a kid, Alaska was up in the great Northwest, and it was much bigger than what it is apparently now. So I don't know how anyone can be a climate change denier here. The continued southward migration of Alaska and the resulting melting of all the icebergs there, causing it to shrink so vastly in size to the point where it's now smaller than Arizona. Greta's right. We got to act now, folks, to save this planet. And by the way, when did Mexico move out of town? When did they get tired of El Gringo Loco in El Norte and just vamoose? And Hawaii just said, well, we can cut down flight times, and they move a little bit closer now. You got to keep up with these maps, I tell you. Well, rounding out the top 5 in there, you have Florida at number 4, Montana at number 5. If we look at the 5 worst state tax states, New Jersey comes in at number 50. My friends in New York will tell you you could label this map anything, and New Jersey should come in number 50. Mississippi is just happy this isn't a chart about edumacation, right? So New Jersey is the worst, followed then by New York, and then California, and then Connecticut, and finally Maryland. So it's largely a New England and California kind of thing for being among the worst. In fact, when this $10,000 cap came in, who did it impact most? Californians, New Yorkers, New Jerseyites, and Connecticutianites. Why? Well, we know from the IRS statistics of income that in 2017, the last year when there was no cap on the deduction for state and local taxes, the average New York itemizer, not the top 1% New York itemizer, but the average New York itemizer, the average New Yorker who was itemizing their taxes instead of taking the standard deduction, was taking an average deduction for state and local taxes in excess of $22,000. So when you tell that average New York itemizer that now all of a sudden they'll be able to deduct $10,000 of their state and local tax most, that, George Costanza, is shrinkage. They feel the pain of that reduction. But you go to Wyoming, you go to South Dakota and say you can only deduct $10,000, they say, well, I don't even pay 10 cents. So what does this deduction really do to me? I don't care. If you're in one of those middling jurisdictions though, or if you're in a high tax jurisdiction, this $10,000 cap can be real, right? And as we think through some planning things about it, keep in mind, it's the same cap for married couples that it is for unmarried individuals. I mean, if you have unmarried individuals who are cohabitating, each of them can deduct up to $10,000 of state and local taxes. But if they get married and they file a joint return, the total deduction between them, $10,000. They've lost half of the ceiling amount that they otherwise could have deducted. And if they file separately, the statute sees that coming and says each one of them can only deduct $5,000 instead. So, yikes. If you're going to any weddings, I think you have a fiduciary duty to have a discussion with the wedding party in advance and let them know, do you really love each other that much? Because you're leaving $10,000 of deduction on the table, and nothing says I love you like extra deduction. So think it through here, kids. We may not want to do this wedding, at least not during the time that this cap is in play. But the second item here on the slide, this I think is of note because this doesn't get a whole lot of play, and here's where we can get some real good planning opportunity. That $10,000 cap on the deduction for state and local taxes, it only applies to your personal state and local tax. It does not apply to your business state and local tax. It doesn't apply to your investment state and local tax. So we say that this is a personal SALT limitation. It is not a limitation on business SALT or on investment SALT. All right? Well, what does that mean for us from a planning perspective? Well, let's imagine that we have the client who has Blackacre that has the family cabin on it, and let's assume that the real property taxes that we are paying on Blackacre for the year is exactly $10,000. Well, poof, there goes our $10,000 cap on the deduction for state and local taxes. I got nothing left to be able to deduct the state and local taxes that I'm paying on the personal residence, my sales tax or my income tax as the case may be, any ad valorem property taxes. I don't get to deduct any of that because it's all going into Blackacre. But if I take Blackacre and I advertise it on Verbo, which I learned a few months ago, we're supposed to call it Verbo now instead of VRBO. Okay, so I advertise it on Verbo or on Airbnb. And if you're not familiar with Verbo or with Airbnb, it's basically Tinder or Grindr for real estate. Because what you do is you create an online profile, you upload a picture from about 10 years ago when it was in better shape, and then when somebody's looking for something to do for the weekend, they scroll through the profiles, they swipe right, they use it for the weekend, and then they're gone. You never see them again. So it's just like Tinder, it's just like Grindr, except it's real estate instead of your dignity. Okay? Well, if I advertise Blackacre on Verbo, whether I rent it out or not doesn't make much of a difference, but hopefully I rent it out maybe once or twice during the time. Well, now, as long as I limit my own personal use of Blackacre to no more than 14 days, Blackacre is no longer personal property. It is no longer a residence. It is now investment property. And the $10,000 of state and local tax, the real property tax that I'm paying on Blackacre, is not subject to the $10,000 cap. I have that $10,000 cap that I can now use for my other state and local taxes. So I can deduct both the taxes on Blackacre and up to $10,000 of personal SALT because I've taken Blackacre from being personal property into being investment property, all because I'm holding it out for rent. I don't necessarily have to turn a profit at the activity for that to be the case there either. And just because I say I can't be there more than 14 days, that means I can't make more than 14 days of personal use. If I actually rent it out to some friends or to some other people for a weekend, maybe I need to be on site on the property to show them the good fishing spots or to help them in case the toilet leaks. I mean, maybe I'm staying over in a side cabin just to be there and be available. So we're not saying I can't be there at all. I can be there when other people are there and it doesn't even count against my 14 days. But I've turned it into rental property and I can deduct the tax. Ooh. I remember speaking about this particular strategy at a conference, and a person came up afterward to explain how it wasn't really for them. And ultimately, I learned that what they really had in mind is that they were just freaked out by the idea of strangers being at the family cabin. And there's just some people who are going to be uncomfortable renting out something like a family cabin to strangers. They worry that knickknacks might be stolen or that there could be damage that's done to the property, or they're just plain creeped out about it. I get it. What I'll never forget, though, is the way that this individual expressed it. Because the individual just said, I just don't like the idea of sharing my toilet paper with strangers. I thought, hold on, Haas. You share your toilet paper? I mean, what is this, Greece? I'm kind of fine that when people use the toilet paper, they just discard it. I don't have any expectation that they would share or even offer to share in that particular case, but okay, whatever. So if you have the client who's like, no, I don't want to rent it out, I don't like that idea. Look at item number 3 on the slide here. Here's where trusts can step in and be of particular use, because what I could do is I could create a trust that is a separate taxable entity. And in addition to transferring Blackacre, I'm going to transfer some investment assets that will generate, let's say in the neighborhood of $10,000 worth of income every year. You see where this is going. Because Blackacre now belongs to the trust, trusts are subject to the same $10,000 cap that you and I are. The trust will have to pay the real property tax. It will use the income that is being generated from those investment assets to pay that tax, so it can also claim that deduction. I still have a $10,000 state and local cap that I can use for my personal residence and for that other property. The house is technically owned by the trust, but the trust is a separate taxpayer than I am, and effectively I have doubled the number of $10,000 caps that have come into play. And if the real property taxes on Blackacre are higher than $10,000, no problem. I just create a second trust. I put half of Blackacre into Trust A, the other half of Blackacre into Trust B. As long as those trusts have either different beneficiaries or different dispositive distribution provisions to them so that they're not substantially identical trusts that allows the IRS to consolidate them and treat them as a single trust, I get yet more $10,000 caps. So if I've got 2 kids, oh yeah, I do, I can create one trust for Tweedledee and another trust for Tweedledum. And effectively, I get 2 different $10,000 caps, and my wife and I still have the $10,000 cap to be able to apply to our other personal SALT. So trust can be a very effective way to be able to multiply the number of $10,000 caps. As long as each trust really is separate and distinct, theoretically, I can have an unlimited number of caps that are sitting there in front of me. So it can be a nice little technique for planning that way. Next up, let's talk about the use of the so-called incomplete gift non-grantor trust. ING trusts, which tells you we don't know how acronyms work, because an incomplete gift non-grantor trust should be called an IGNIT. But I think that sounds too close to IGNATs. So instead, they go with an ING trust, or if you set one up in Delaware, they call it a DING trust. So now it sounds like ding, 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 like you won on a game show. But you don't have to do it in Nevada or in Delaware. You can do it in Nevada and do a NING trust. You could do it in Florida, I suppose, and have a fling. You could do it in Tennessee and have a ting, although you might need some of that penicillin for that. In any jurisdiction that doesn't impose state income tax, you could set this up. This particular strategy has been around for a long time, but it really didn't get a huge green light until the Supreme Court decided a couple of years ago the case of the North Carolina Department of Revenue versus the Kimberly Rice Kasner 1992 Family Trust. Boy, if you were making a Mount Rushmore of Supreme Court cases, what do you got on there? Marbury versus Madison, McCulloch versus Maryland, Brown versus Board of Education at Topeka, and clearly the Abe Lincoln head is saved for North Carolina Department of Revenue versus the Kimberly Rice Kasner 1992 Family Trust, right? I mean, what a groundbreaker that was. Remember what happened in that trust. Father who lives in New York sets up an irrevocable non-grantor trust, a trust which is treated as a separate taxable entity for the benefit of his 3 kids. First thing the 3 kids do is they convince the trustee to divide it into 3 separate trusts, one for each of them. Which you and I know that's what kids do. It always tends to disappoint the clients, right? Clients always have this romantic notion that, well, if we leave Blackacre to the 3 kids as tenants in common, they will set aside their petty differences and they will come together to protect the family heirloom, and this will be something that unites them and brings them together and helps to build relations that had been torn down. Whereas you and I know in real life, before the pilot light has been lit at the crematorium, one of the kids has already run to the court of applicable jurisdiction with an action to partition Blackacre, to divide it into 3 separate parcels so that each one can take their parcels, they can sell them, use the proceeds to, and then go on about their lives, right? I mean, the clients are always disappointed, but we just know that's what happens. Well, we got 3 different trusts, including then one for Kimberly. Well, let's talk about Kimberly's trust. Kimberly's trust provides that until she reaches age 40, the trustee has the discretion to make distributions to her as needed for her health, education, maintenance, and support. When Kimberly turns age 40, the trust will terminate and everything inside the trust that wasn't already distributed gets distributed to Kimberly. And if Kimberly dies before age 40, she can, under her will, designate who will take in her stead. So this is a pretty straight over tackle support trust. And I don't think there's any question this trust is for Kimberly, because one way or another, Kimberly will either receive or will control who receives all of the benefit inside of that trust, right? Well, during the taxable years at issue, the trustee, there were 4 years that were at issue, the trustee never made a distribution to Kimberly. She has enough independent wealth, she's fine, she doesn't need anything. But nonetheless, the state of North Carolina was taking the position that even though no distributions had been made to Kimberly, who was a resident of North Carolina, that they still had the jurisdiction to be able to tax this out-of-state Yankee trust. Why? Because the trustee was there? No, the trustee was based in Connecticut. Is it because there was North Carolina situs assets? Did we own an interest in a tobacco farm? No. The only assets of the trust were an investment account that was managed out of a bank account in Boston, Massachusetts. It was Massachusetts-sourced income. The only connection that the state of North Carolina had with this trust was that Kimberly was a resident there. Now, there's no question that if the trust had made a distribution to Kimberly while she's a resident of North Carolina could tax Kimberly on the income that she receives from the trust. That's kind of how the taxation of trusts works. But when the trust is not deemed to be owned by Kimberly or by her father, but is instead its own separate taxable entity that is paying the tax itself, North Carolina, you wouldn't think, would have jurisdiction, but they assert jurisdiction to tax. The trustee of the trust pays the tax and sues for refund in state court. So you've got a state court proceeding determining whether the state of North Carolina has the jurisdiction to tax this trust. And I can't help but think that the North Carolina Department of Revenue is probably about 3 doors down from the state court that's deciding this issue. Heck, they probably do Secret Santa together. You're going to ask a state court, do we have the jurisdiction to tax this out-of-state trust? Do you think the fix is in? They're going to say, of course we do. But the court said, no, we don't. North Carolina Department of Revenue appeals the case to the North Carolina Supreme Court. That court says, no, we don't have the jurisdiction to tax. The North Carolina Department of Revenue is now panicking, thinking, oh my gosh, not only have we taxed this trust, but we've taxed a whole bunch of other trusts like this. Suddenly we're going to have to refund all this tax. It's going to hemorrhage a whole bunch of cash. We're going to have to do rolling blackouts or something else like that in this state to help make ends meet. They appeal to the Supreme Court. And in a deeply divided 9-0 decision, the Supreme Court holds that North Carolina does not have jurisdiction to tax on this basis. Well, that solves the problem as far as Kimberly's trust is concerned, but what does it do for the rest of us? It tells us that the incomplete non-grantor trust, that's a game changer. That baby works. What you do is you create that separate taxable entity, the non-grantor trust, administered in a state that does not have a state income tax. So if I situs this in Delaware, I use a Delaware trustee. Like Kimberly's trust, I'm going to put in a spendthrift clause that would say my beneficiary who's in state does not have any power to be able to sell or transfer that interest. Furthermore, I'm going to make sure that that in-state beneficiary has no say in trustee removal or in trustee replacement. Then I'm going to have the grantor transfer income-producing assets, but in the form of an incomplete gift. I'm going to allow the grantor to retain some testamentary power to be able to appoint the remainder of the trust by will. That doesn't make it a grantor trust for income tax purposes. That's important. This can't be a grantor trust for income tax purposes. But it keeps the assets inside of the grantor's gross estate. So the trust is still a separate taxable entity, but when we get the death of the client, we're still going to get a step up in basis for the assets that are in there. So we're not going to have our home state imposing any state income tax unless and until we make a distribution to an in-state beneficiary. And because the assets going in went in through an incomplete gift, there's still going to be the step up in basis when the grantor dies. The only reason you're doing this is to save on state income tax because you're still going to be paying as much, if not more, in federal income tax because this income is sitting inside of a trust, which remember has very thin tax brackets. But if your state income tax is high enough such as to make this worthwhile, the use of the ING trust is phenomenal. Now, not every state lets you get away with it. New York and California, they have statutory provisions that make the use of the ING trust particularly unattractive. And you might be working out of a jurisdiction that has something similar to that, that would say, for example, you are the deemed owner of a trust, even if it's not a grantor trust for income tax purposes, if you park it in another state. That's what New York has done. You might have a throwback rule like California. It says, well, when you do make a distribution, not only can we tax you on that distribution, but on all the undistributed income as well. Other things that can make it a little bit more complicated. But if your state hasn't tumbled to that yet, this can work out really well. A fantastic technique that we have to talk about in connection with retirement plans deals with naming a charitable remainder trust as your beneficiary of your retirement plan. Again, all of this comes to us thanks to the Secure Act, which we had talked about during the update portion of the presentation, where we said that, look, in addition to delaying the starting age for required minimum distributions and caps on IRA contributions and the like, there was, as the signature feature from our perspective of the Secure Act, this thing that said, well, you can no longer do a lifetime stretch out for most of your designated beneficiaries. You can only do a lifetime stretch out for eligible designated beneficiaries. For everybody else, you have 10 years to withdraw the account down to zero. So let's be clear. If I name my spouse as the beneficiary of my retirement plan, my spouse has her remaining life expectancy to withdraw that account down to zero, which is great because that means that I can give it out in very small amounts over a longer period of time, deferring the imposition of tax and making it so that I'm not pushing her income into a higher bracket each year for tax purposes. If I name a sibling who is, say, 5 years younger than me, that sibling, as you see, is an eligible designated beneficiary. The sibling can use the lifetime stretch out. But if I name my 21-year-old son as the beneficiary of my retirement plan, then they have 10 years to withdraw it and to get it all the way down to zero. Even if I create a trust for the benefit of my son, we still have 10 years with which we have to withdraw it to zero. But what if I instead name a charitable remainder trust as the beneficiary of my plan? And I'm going to design this charitable remainder trust so that it is my adult son who will receive annually from the trust either a fixed dollar amount, if it's a CRAT, or a fixed percentage of the net fair market value of the trust assets, if it's a CRUT. I can design that lead interest to last for my son's life. I don't have to do a term of years. We usually do a term of years because usually the lead interest is held by the donor rather than by a child of the donor. But here it is the child of the settlor that is named as the beneficiary. That annuity interest or that unitrust interest lasts for life. When my son dies, whatever's left inside of that trust can be payable to the Salvation Army or whatever other charitable organization or organizations that I have identified in advance. Now, because the trust is now the beneficiary of the plan, the Secure Act rules or the retirement plan rules require that because this is not a see-through trust, the trust as a separate taxable entity has only 5 years to withdraw my account down to zero. But that's no big deal because a charitable remainder trust, remember, is tax exempt. We are going to tax that income when it is distributed to the lead beneficiary. In other words, we're not going to tax the trust. The trust has 5 years to withdraw down to zero, but heck, the trustee will just do it the day after the trust is formed. There's no reason to wait around on it. The tax will be paid as my son receives the payments, which is exactly what we were able to get when we could do a lifetime stretch out, naming the son or a trust for the benefit of the son as the beneficiary of the plan. So the charitable remainder trust allows me to effectively mimic a lifetime stretch out by giving a lifetime interest to the adult child, but it has an additional advantage in the sense that if the trustee can manage this trust assets in a way that generates a sufficient rate of return, there can actually be a substantial amount left over after the death of my son that can go to the charity or the charities of my choice. So I can not only mimic the lifetime stretch out that I used to be able to get before the Secure Act came into effect, I can also make a substantial contribution toward my philanthropic agenda at the same time. So just as orange is the new black, charitable remainder trusts are now the really cool beneficiary to be naming for the IRAs or for the retirement plans when the client doesn't have a surviving spouse or when the client doesn't have a sibling or someone else who is an eligible designated beneficiary. In those situations, you really ought to explore or recommend that the client explore the use of the charitable remainder trust instead. All right, another technique is the use of this ultra long-term GRAT. Normally when we create the GRAT, the idea is that we want the donor to survive the term of the GRAT because otherwise, remember, the assets of the GRAT get included in the gross estate. The idea here is that we are going to create a GRAT where we know for sure the donor is going to die and there will be gross estate inclusion. Now, at first you think, well, that's nuts. Why would I do that? Because I'm causing gross estate inclusion at the back end when I don't necessarily have to. Aren't I causing all of those assets to be subject to estate tax at the death of the donor? The answer to that is no, not really, because what the GRAT regulations require is if you die during the term of the GRAT while it's still in existence, what's included in your gross estate is not necessarily the full fair market value of all of the assets. What's included in your estate is enough to be able to fund the remaining annuity payments for the rest of the term. And the regulations say that the way that we compute that amount is that we take the annuity amount that was payable to you under the terms of the GRAT and we divide it by whatever is the 75/20 rate in effect at the date of death. So, if I can create a zeroed out GRAT using a 75/20 rate today that is lower than what will the 75/20 rate be at the time when the client dies, we're probably not going to include 100% of the value of the assets. In fact, we may only be including a fraction of the value of the assets instead. This is another one of those concepts like the lead trust where I think sometimes seeing the numbers helps it to make a little bit more sense. Let's suppose that I put $10 million into a 60-year GRAT, and I hypothesized here originally doing it in September because I had to turn these slides in September when the 75/20 rate was 3.6%. In order for me to zero out that GRAT, I had to retain the right to receive every year, as you see, an amount almost equal to $409,000. Let's assume, though, that I die 20 years after the formation of this GRAT. And let's assume that the 75/20 rate 20 years from now is at 6%. Why am I assuming that? Well, if you assume interest rates fluctuate, I just figured, okay, let's assume the 75/20 rate 20 years from now is the same as what it was 20 years ago. And 20 years ago, it was 6.0%. So if I do that, what would be included in my estate is we would take that 408,993 and we would divide it by 6%. And as you see, that gives us a number just north of $6.8 million. So that's how much I have to include in my estate. That's how much my estate has to pay estate tax on. But if we assume that this trust grows at a rate of 6% each year over that 20-year period, at my death, even after the annuity has been paid to me, there's going to be over $17 million sitting inside of that trust. That means I'm only including 6.8 of the $17 million. Only about 40% of the value of the assets is included in my estate. Now, as the 75/20 rate goes up, the attractiveness of this option goes down. If I do this same transfer today, look at the numbers. In order for me to zero out a GRAT using today's 75/20 rate, I have to pay myself a higher annuity, which means now instead of there being 17 million, there's only going to be 15.8 million left inside of that trust when I die. And instead of having just over 6 million included in the estate, there's now 7 million included in the estate, so now it's 47% of the trust assets being subject to tax. And if I use next month's 4.8% interest rate, more than half is being included. The real winners here were the people who did this strategy when the 75/20 rate was 0.4%. They can already die and become big winners under this because a very small fraction, less than 5%, is being included in their estate. The longer we wait and the higher the 75/20 rate becomes, the less attractive these particular strategies can end up being. All right, we wanted to be able to save some time for some Q&A, so I'm going to turn things back over to Phil right now because Phil has been collecting all of the questions that you've been sending in, and we'll see what we can do to answer those questions in the time that we have before our scheduled lunch break. Phil, did anybody send in any questions?
Yes, Sam, we do have some very good questions for you. The first question is, how do you see the effectiveness of GRATs changing with higher interest rates?
Well, as we've just talked about, the higher the 75/20 rate, the higher that interest rates become, the less attractive GRATs are. GRATs were in their heyday during the time of the late 2000s and for all of the 2010s and for the first part of this decade because we were in low interest rate environments. In a low interest rate environment, I can zero out the remainder interest in a GRAT. In other words, I can structure the GRAT so that I'm not making a taxable gift at all without having to require the trustee to make a ginormous annuity payment coming back over to me. And in fact, if the trustee can generate a rate of return that is higher than the 75/20 rate, which in an era when the 75/20 rate was below 1%, they could do and could do pretty easily. In fact, although 75/20 would tell me to assume that there's nothing left inside that trust, there would be something left inside that trust at the end. And so, and depending on the amounts that I went in and how long this trust would last, there could be very significant amounts left inside of that trust. So GRATs are something that work very well in a low interest rate environment. I know this is difficult to understand and appreciate, but even at a 4% 75/20 rate, that's still comparatively low. In the lifetime history of 75/20 rates, I mean, we've seen it be 12 and 13%. So 4% is not exactly high. Compared to what it's been, it looks dramatically high. I would think properly structured GRATs still have a role, but they're becoming a little bit less attractive. You got to have 3 or 4 beers before a GRAT looks as good as it did just a year or two ago.
Thank you. That's very, very helpful. We have another question. If someone is setting up a conservation easement, should they also submit a private letter ruling requesting approval of the deed language or else risk the disallowance of the deduction?
Well, good question. One thing that you should know, if you're going to have a client who sets up a conservation easement, be prepared for the fact that the service will examine the return. There's no such thing as the easement that slips by on their computer, because when you claim the conservation easement, they will do an inspection. And let's be clear, they're not going to be doing the age 40 inspection. They're going to be doing the age 50 inspection on this. They are going to white glove this like you would not believe. They're going to be checking to make sure every I dotted, every T crossed. They're going to be looking for that fatal language inside of the deed and all of that. So what is often recommended for those that are doing the conservation easement is that you don't get one appraisal, you get multiple appraisals, because even if you're complying with all the picayune requirements of the regulation and having the deed language right, the IRS can still fight on the valuation of the easement claim, and you need to be prepared to defend those numbers too. The specific question of do I need to pay for a letter ruling, you might not get a letter ruling from the IRS. They're not really in the business anymore of just blanking, looking at a deed and saying, oh, you're good to go, you're perfectly fine, we won't examine it. They want to see you make an opening bid on the amount of the contribution that you're making first, and then they'll go from there. So certainly you'd want to have your language reviewed by some people. I don't think you're going to be successful in getting a ruling request in advance, but be prepared to do the audit. Now, look, as long as you're complying with all the rules that are in play, and if all you're really doing is fighting about valuation, you've already won. It's just a question of to what extent do you win. So if you're claiming an 8-figure conservation easement deduction, spending 5 figures to defend yourself with multiple appraisals and opinion letters and the like strikes me as a pretty wise investment and a pretty cheap insurance policy.
Very good. Thank you. Very wise counsel. Another question.
You're supposed to say that.
Yes.
On all the questions. Go ahead.
Another question. Can you include a conditional general power of appointment in a SLAT for the beneficiary's spouse to exercise to obtain a step-up in the event the exemption amounts do not change?
Yeah, we didn't get an opportunity to talk about the SLAT or the Spousal Lifetime Access Trust, and if that term is still kind of fuzzy for you, or if it's one that you never really felt like you understood, let's just give a little bit of context to kind of tee up the question a little bit more here. The Spousal Lifetime Access Trust effectively works like a credit shelter or exemption or AB trust. It just is created during life rather than at death. Normally with a credit shelter trust, of course, after the death of my spouse would then put their assets into this trust that says, well, it's there for you, Sam, if you need it, but if you don't need it, let's just let it sit there and grow, because since you don't control those assets, they will not be subject to estate tax when you die. We are allocating the deceased spouse's exclusion to that amount. I don't claim the marital deduction for anything going inside of that trust. And so if that trust that's funded with $10 million, if only my spouse had that much, could grow and grow and grow to 20 million, to 30 million, to 50 million, no matter what it grows to, there's not going to be any estate tax at my death. Well, the only way traditionally that I could take advantage of that was to put a pillow over my spouse's face, and then we could create that trust. With the SLAT, I don't have to wait for that, and I don't have to have anything traceable back to me. My spouse can, while she's alive, go ahead and create that trust for my benefit, but it's a trust that doesn't qualify for the marital deduction, and we allocate her exclusion amount to that. And, why wait to use that $12 million exclusion? She can go ahead and do so now through the creation of that trust, and those assets can grow and grow and grow, and there won't be any estate tax when I die. Typically, in fact, we would even give me a limited power of appointment over that property, particularly if this was a second marriage scenario where the remainder beneficiaries of that trust after I die would be her kids. Very often we would give the spouse a limited power of appointment as an incentive for the kids to be nice to the spouse, because otherwise they're like, well, why should we care? Why should we come to see you for the holidays? Why should we send you any flowers? Because our interest is already vested. So they're coming at you with ice picks. So make sure that they stay nice and you have that limited power of appointment. The question that Phil was posing on behalf of a viewer is, can we also give that surviving spouse a general power of appointment so as to cause gross estate inclusion of those assets? But more importantly, would we have it be a conditional one? I don't know that you necessarily have the conditional one as much as you might have the trust protector, as we talked about before, that could come in and give that surviving spouse that power. But yes, absolutely, that could be something that can be contemplated, or even if you have a slat that's already been created, you might be able to, under your state laws, decant that existing slat into a new and improved slat that has that general power of appointment condition that is built into it, so that if gross estate inclusion would not result in any estate tax on the death of the surviving spouse, giving the surviving spouse the power to be able to appoint can get us that step up in basis on the surviving spouse's death. Now, sometimes you got to be careful in how you craft that general power of appointment, because some of your clients may not be very comfortable in how that's exercised. I mean, if you think it through, let's use a stereotypical example. Let's have husband and wife, and let us do as God intends and kill off the husband first. Well, what is every dead husband's biggest nightmare? That nightmare, Phil, as you know, is that the wife is going to massively upgrade. She's going to go out there and find some boy toy 2.0 who's going to bring to the table all the things that that evil troll spouse 1.0 never had. Hair, discernible abs, not having to be all Channing Tatum and everything, because, you know, frankly, after the first few years, you kind of want something softer to lay your head on at night instead of that hard washboard that's there all the time. But also not something that's like so disgusting that when you go to the family cabin there in the summertime and he takes off his shirt at the lake, the wildlife stops and looks at this stretch mark infested, mole covered, hairy sack of flab hanging over the top of the suit that blows in the breeze there with the lake, right? That's so bad he has to wear a vest just to have the confidence to speak in front of a group of people. Perhaps I'm projecting here. But the spouse doesn't want, the dead spouse doesn't want the living spouse to have a general power of appointment, even if that's good from a tax perspective, because then the fear would be, well, we would use that general power of appointment to appoint it to the spouse's estate that now provides for trim Fabio and his locks of hair. In that case. And so I don't want to give my spouse that general power. The whole reason why I'm putting it into a trust, I mean, why is it called a trust? Because it supplies what's missing in the relationship, right? If I trust my spouse, I don't need a trust. It's precisely because I don't trust my spouse that I'm putting the assets inside of a trust. I'm nervous that if I give my spouse a general power of appointment, the spouse is going to use it in a way that's contrary to what I want, which is for it to go to my kids. And if my kids have my genes, good Lord knows they need a $sign as their profile pic on Tinder if they're going to have anybody swipe in the correct direction. Up, down, left, right, I don't know what it is. I'm too old for that. I don't want that general power of appointment. Well, how about this? If you give the trust protector the power to confer on the surviving spouse, a power to appoint to the creditors of the surviving spouse's estate, okay, that makes it a general power of appointment. It's a general power of appointment if you can exercise it in favor of yourself, your estate, your creditors, or the creditors of your estate. Now, who are the creditors of the surviving spouse's estate? Visa? Amex? What are the odds that a surviving spouse is going to name a creditor of the surviving spouse's estate as the beneficiary of this trust under this general power of appointment? Infinitesimally small, right? Well, good. We just want the spouse to have the power. We don't really want the spouse to exercise the power. So yes, you can give a narrowly crafted general power of appointment to the surviving spouse and be able to preserve the ability to be able to get the step up in basis that way. We use it not just in the context of slats, we use it in the context of credit shelter trusts in some cases too, when it can be converted out that way. Lots of the interspousal trust planning that we do would have that feature. So yes, feel free to do that.
Very good. Are federal tax liabilities required to be paid by the taxpayer's estate if the IRS fails to timely file a claim in the estate case probated in the state, or county of residence? Example, taxpayer died end of March 2022. In April 2022, a state administration filed and personal representatives are appointed. Tax return for 2021 prepared and filed. Tax liability for deceased individuals around $5,000. The estate attorney properly notified the IRS to file a claim with the probate court. IRS fails to file the claim in the state probate court. The timeline to file a claim has expired. Is the IRS tax liability barred like other creditors who fail to timely file?
Phil, I like how this is obviously clearly a hypothetical situation and not at all based upon a real fact pattern that's on somebody's desk. And somebody is just asking for the benefit of others and not because they might have that current situation flooding their email inbox. While the exact answer to this can be a little bit of a function of state law, and I am very likely not admitted to practice in the state in which this question is coming from, and so I'm not in a position to be able to opine on the extent to which state law can work with this, I can tell you that as a matter of federal law, that federal tax lien is not disappearing just because a state probate court has said the time to file a claim has disappeared. Federal tax liens have a remarkable ability under the Supremacy Clause to outlive any state law attempt to try to shut them down. So the normal statute of limitations that would apply for the IRS to be able to assess a deficiency is going to apply even if the period for which the IRS to appear as a creditor in a state court probate proceeding has long since passed. Now, all of the exact nuances and everything else along that line and how that state court proceeding is going to work is again going to be a question of state law, but telling Uncle Sam you're too late, no relation Uncle Sam, you should know is not going to be an effective argument.
Thank you for your counsel. Final question. Why didn't the IRS publish or bring before Congress the need to have the health coverage tax credit extended as the credit ended on December 31st of 2021. Many taxpayers qualify for this credit, and effective 1/1/2022, they received notice after submitting their insurance payment to the IRS only for it to be returned with a notice saying Congress failed to vote on extending the credit. Contact your local congressman. In this case, Indiana Department of Workforce Development sends notice in January 2022 who are on the TAA, Trade Adjustment Assistance Program, that they will qualify for the health coverage credit and to contact the IRS to complete the forms. Companies who relocate from Indiana to Mexico filed a petition with the Indiana Department of Workforce Development. And in the petition, it shows that those who participate in the Trade Adjustment Act assistance program will qualify for 2 years 21 through 2022 for the health coverage tax credit. And said petition is approved by the Department of Workforce Development. Yet the IRS says the credit ended at the end of 2021. Would you like to opine on any of that scenario?
Well, I'm not so sure I was tracking all of where we were going among the various states that were happening there, but the question started as, why didn't the IRS see this being extended? And we should remember that almost every year there are provisions of the code that will sunset, some of them being beneficial, others of them not, some of them being limitations on restrictions that will die. And it's up to Congress, typically in the form of an extender bill, to keep some things living from one year to the next. We have a sense that there would be an extender bill that would coming, if not this year, perhaps in 2023, just to address things like accelerated depreciation and a few other provisions that are hitting some hard sunsets that are coming up here in the next year or two. But if the question is, why didn't the IRS extend this? Let's make sure that we lay the blame at the appropriate step. This is not an IRS problem. This is a Congress problem. The IRS does not propose tax legislation to the Congress. The IRS does not even have a duty to inform Congress of provisions of the law that are set to expire. The Congress has its Joint Committee on Taxation. The Joint Committee on Taxation advises Congress as to provisions which are about to expire. Very often then that is the thing that leads to an extender bill. But what we have seen in Congress, not just of this last year, but in the past decade or so, has been even an inability to be able to get a simple extender bill passed without some degree of controversy or fanfare or bluster that happens, to the point where it's just been easier to let some of the provisions expire. So if you're feeling chuffed that the IRS is telling you, well, go write Congress, they're telling you the right thing. The answer is it's Congress's fault when a provision sunsets and is not extended, and it's Congress that gets the credit when such a provision is extended. So when the IRS is telling you, sorry, it's too late, you can't do it effective for 2022, even if your state government is telling you so, as a matter of federal tax law, the provision expired, the IRS is right. And yeah, it's up to Congress to have to decide whether and when to extend a benefit, and even to decide whether it is retroactive. So let's not be part of the problem that perpetuates that this is the IRS's fault. Let's be accurate in what we are telling our clients. We share their frustration. We think that they have been wronged, but it's not the IRS that needs to get the hate mail here. It's Congress.
Yes, thank you. Two additional questions popped in. I understand certain businesses can deduct the amount above the SALT's $10,000 limitation to benefit taxpayer. What's the fact pattern for this?
Well, this goes back to what we were talking about before when we said that the $10,000 cap applies to your personal state and local tax, but it does not apply to your business state and local tax or your investment state and local tax. So if I am a sole proprietor, or if I have a disregarded LLC that I'm using to operate my business, all of the taxes that the state and local taxes that I'm paying in connection with my business are not at all subject to that $10,000 cap. They don't contribute toward the $10,000 cap. I still have the $10,000 that I can use for my own personal activities. We did mention a fact pattern where we took Blackacre, the personal use property, and we made it into investment property precisely so we could take it out of the application of the $10,000 cap. If you wanted to, you could be actively involved in the rental of that Blackacre property. And by your active involvement, if you contribute enough hours during the course of the year, it becomes a business activity. And not only do you get to deduct your $10,000 or more of business SALT without any limitation, but you can even have it so that you qualify for that qualified business income deduction under 199 Cap A and only have to pay tax effectively on 80% of your net rental income, because you get a reduction in the tax rate that applies to your income, because you get to deduct 20% of your net business income in addition to all of the other business expenses that you get to deduct as well. So really, any of the state and local taxes that you are paying in connection with a business activity, deduct them without limitation. State and local taxes that you are paying in connection with investment activities, like holding out rental properties for rent, you can deduct without limitation. The cap is only applying to your personal state and local taxes.
Very, very helpful. The final question, they'd like you to speak into this. The IRS has adopted the position that a beneficiary of an IRA owner who dies after their required beginning date must use the applicable life distribution rule applying to the beneficiary and also comply with the 10-year rule if applicable. That is, a beneficiary is unable to use just the 10-year rule when the IRA owner has died after their required beginning date. Number one, the IRS announces that the to-be-issued final RMD regulations will apply to 2023 and subsequent years. Number two, the IRS has stated it won't assess the 50% tax for 2021 and 2022 for the beneficiaries of IRA owners who died in 2020 and 2021 who had died after their required beginning date. They'd like you to speak into that.
Well, what do you want me to say other than the summary that you just read is an accurate portrayal of the position that the IRS is taking there. If you're asking about what's the likelihood that that would come to fruition and be the position, I suspect it would be quite strong. I mean, in fact, they're kind of giving you the early signal that this is the direction in which we're going, and there doesn't seem to be any real reason for them to be on a different track with that line of thought. So the way that you have explained the application of this shift in the rule and what's supposed to happen under the Secure Act and the application of that 10% rule in the case of somebody who's stepping into the shoes of somebody who was already receiving minimum distributions was entirely accurate, and I think very well stated and nice and concisely stated. The likelihood, I suspect, of it coming into play is strong, and we have to plan for it accordingly. Doesn't mean, though, that Congress couldn't impose a different rule, that if there was widespread objection to the application of that approach, convincing Congress to adopt a better or different approach is something that's well within the bailiwick of Congress to be able to do. So could we see Congress intervene and impose something different? I suppose so, except watching our current Congress seem to be able to do anything. I'm not sure you could get a joint resolution agreeing to the sun rising in the east and setting in the west much anymore. So being able, even to be able to get backing behind something as relatively benign and as friendly as that overruling of the IRS in that regard and doing something more taxpayer friendly or something more flexible might be asking a lot of this current Congress. Who knows? But sorry to disappoint you with not having anything a little bit more sage or insightful or rumor has it or insider kind of knowledge that's there. But I think the description is bang on.
Thank you, Sam. And if anybody has any additional questions that come in after this time period, please send them, and I will forward them to Sam, and he will graciously reply, and we'll get by email an answer to you. And we, of course, do need your email address to get your answers back to you from Sam. I want to, on behalf of the Salvation Army Central Territory, thank Professor Donaldson for his excellent handout materials, wonderful and obviously very funny presentation today. It kept rather sometimes technical material quite lively and interesting. And Professor Donaldson, we appreciate your time and your commitment to helping all of our advisors throughout the territory be up to date and, in fact, be as cool as the cool kids are. And that's much appreciated. We're now going to break for lunch. We will convene at the top of the hour, 1 o'clock Central Time, 2 o'clock Eastern Time. Have a good lunch, and please do come back. Thank you very much.